Finance 101 quiz. This is 10 multiple choice questions and answers. And I'm going to give you an explanation after each individual questions. You will have 15 seconds to answer each question. And I want you to comment below how many of the 10 questions you got correct. All right, let's dive into the Finance 101 quiz. Question number 1. What describes the estimated value of an asset at a specific point in time based on an assumed interest rate or rate of inflation? A, present value. B, future value. C, compound annual growth rate. D, net present value. The answer is B, future value. Now, this is the time value of money. The future value is an estimated value of an asset at a specific date based on an assumed interest rate or inflation rate. Basically, you're going to take a set rate over a period of time, and you're going to have your starting value, and you're going to use the formula below to calculate what that future value will be based upon your inputs. Question number 2, what is stock dilution? A company redeems shares, lowering shares outstanding. B, a company increases shares issued and outstanding. C, a company issues 10-year bonds. D, a company redeems zero coupon bonds. The answer is B. The company increases shares issued and outstanding. When a company issues more shares and a current shareholder does not receive a pro rata portion of the shares issued, that shareholder's ownership will be diluted since there are more shares issued and outstanding. In other words, the denominator of the ownership equation has increased while the numerator remains the same. Question number 3. Compound annual growth rate, CAGR, measures A, average diluted earnings per share. B, investments average annual growth rate. C, average stock price per year. D, average cost of debt and equity financing. The answer is B, investment's average annual growth rate. CAGR measures an investment's annual growth rate over the time, which factors the effects of compounding. Basically, you are looking at the return on investment for a particular asset, and what CAGR is going to do is smooth out the average rate of return for each year. Question number 4, how do you calculate dividend yield? A, dividend per share divided by share price. B, dividend per share times share price. C, dividend per share times earnings per share. D, share price divided by dividend per share. The answer is A, dividend per share divided by share price. Dividend yield is the dividend per share that you're receiving divided by the share price expressed as a percent. This is a similar idea, similar concept to interest, the interest rate on a bond expressed as a percent. Question number 5, how do you calculate earnings per share, EPS? A, EBITDA divided by weighted average shares outstanding. B, weighted average shares outstanding divided by net income. C, net income divided by weighted average shares issued. Or D, net income minus preferred dividends divided by weighted average shares outstanding. Answer is D. You're going to take your net income from the P&L and you're going to subtract out any preferred dividends and you're going to divide that by weighted average shares outstanding. That is going to give you earnings per share, and that is a big driver of stock prices because you want to see earnings per share going up. If you've gotten any value out of this video so far, please smash that like button and consider subscribing. All right, question number 6. What is the strike price on a stock option? A, fair market value of the stock. B, price the option allows you to buy the stock at. C, price of the stock when it's out of the money. Or D, price of the stock in 10 years. The answer is B, the price the option allows you to buy the stock at. A stock option will have a strike price, and that strike price is going to be the price you can go and say, I want to buy shares, and I have this option, I can buy them at X dollars. So you might get a strike price of $10, and the stock price has gone to 30. You then can exercise those options, buying at 10, and you have a $20 built-in gain when you're buying your shares because you have a strike price at $10. Question number 7. What is a reason a company would buy back its own shares of stock? A, to increase liquidity. B, to lower tax liability. C, to finance a new acquisition. Or D, the increase earnings per share or other financial metrics. The answer is D, to increase earnings per share or other financial metrics. When a company buys its own shares back, it's reducing the total number of shares outstanding in the company. If there are less shares outstanding, metrics like earnings per share will go up because earnings per share, you're taking the net income less your preferred dividends divided by the average shares outstanding. So if there's less average shares outstanding, with a lower denominator, you're going to have a higher earnings per share number. Question number 8. Which one of these is not a liquidity ratio? A, current ratio. B, quick ratio. C, cash ratio. D, inventory turnover ratio. The answer is D, the inventory turnover ratio. That is not a liquidity ratio. That is an asset management ratio. Current, quick, and cash, that is going to be looking at your current assets and how much cash and how much current liabilities you have on your balance sheet. Those are going to be your liquidity ratios. Question number 9. What is a financial statement projection? A, financial statement that agrees to your tax return. B, a cash position of a prior year. C, prospective financial statements based on assumptions. Or D, historical financial statement. The answer is C, a prospective financial statement based on assumptions. Projections are financial statements where you have historical information and then you're going to layer in future assumptions to get an estimate of what you think your projected results will look like. Say you're in May and you want to know what your year-end, your December 31st financials are going to look like. You're going to take your year-to-date results through May and then you're going to layer in assumptions to get an idea of what your projected financials are going to look like. Question number 10. Interest rate risk describes the risk that A, a value of a bond will decline due to interest rates. B, a value of a bond will decline due to inflation. C, a value of a bond will decline due to bad debts. Or D, a value of a bond will fluctuate with the stock market. The answer is A. A value of a bond will decline due to interest rates. Interest rate risk is the probability of a decline in value of an asset resulting from an unexpected fluctuation in interest rates. All right, that's our Finance 101 quiz. Let me know in the comment section how many you got correct, and be honest, let me know how many of the 10 questions you got correct. All right, I hope you learned something from this video, and I will see you in the next one. Take care, and goodbye.
Yeah.